Hello everybody. So welcome to this video entitled The Most Undervalued Growth Stocks. And this is a video where I cover most of the stocks that I've already covered on my channel. There's more than 30 stocks in there, and I run them through my usual valuation spreadsheet. And so this is the updated spreadsheet as of this morning before the market opens with the valuation. And this video is going to include my commentary on all of the stocks, and I'm going to go through each of them. And it has been 3 weeks since I have done a video like this. The last video like this I did was September 5. So in the comment section, if you tell me I always make video, it's been 3 weeks. But I kind of want to give you an update, right? So if you are new to the channel, and this is what these videos are for new viewers mostly, right? If you're new to the channel, welcome. And let me show you what I do on this channel. So what I do on this channel, the way I invest is I invest in product adoption or service adoption. And I focus on growth stocks. So why do I have the mix of growth stocks and also product adoption and service adoption? Well, the reason for that is because I want to achieve 30% revenue growth compounded over multiple years, 10 years, 15 years if I can. My style of investing can be summarized with this product adoption curve right there. This is the famous S curve. And the style of investing that I do is I try to get into a stock when adoption is at, 5-ish, 10-ish% of the product, and then I want to ride that stock all the way until the product is adopted by, say, 80 to 90% of the people in the market. Once it is adopted, I want to get out of the stock at the early sign of a growth slowdown. And once the growth slowdowns, that's when the company matures and when the company starts getting valued like a value stock and on the basis of PE, etc., kind of your stereotypical S&P 500 stock, right? My stocks are hyper growth stocks. They follow the steepest portion of that S curve. And so I want to ride product adoption. And that's where, this level of the curve, this area in the curve is where you typically are going to get 30% plus revenue growth over multiple years, hopefully a decade. And how do I deem whether a stock is overvalued or undervalued per my spreadsheet? Well, I use this metric right there, which is enterprise value over gross profit over revenue growth. This metric right there tells me how much am I paying for each 1 percentage point of forward growth. And the goal is to pay as little as possible. And the less you pay for each 1 percentage point of forward growth, the cheapest the stock, right? And so you'll see I have stocks that are very expensive like NVIDIA, and I have stocks that are very, very cheap like HIMS based on the cost of that forward growth. So you divide the forward revenue growth, right? That's your denominator out of the EV over gross profit, which is the spin on the P ratio. It's not a P ratio. It's better than a P ratio. You may see that this looks very much like price to earnings to growth from Peter Lynch, but I've changed it a little bit. And I consider EV to gross profit to be more adequate for my strategy, because my strategy is not about established companies. It's not about earnings. It's about gross profit. And so I use enterprise value because enterprise value is better than market cap in my view, because it takes debt out of the equation and penalizes companies that have a lot of debt. And I use gross profit because gross profit is about as far down as I'm willing to go into the balance sheet without seeing accounting issues and wild fluctuations. I think gross profit is as flawless of a metric of profitability as you can get, but whenever you get lower into the income statement, I meant income statement, the lower you get into the income statement, the more you get into all sorts of discretionary items, and it's all a matter of how the accountants categorize them. So I like gross profit. I think it's a purer metric. And so let me move on. Let me answer the question. What is the most undervalued stock right now? And I am sorry for those who tell me it's always the same video, but it hasn't changed. It has not changed. It is still HIMS, StoneCo, and Lovesac. These are still the cheapest stock in my spreadsheet, And HIMS, if I look at a stock like HIMS, does it have a 2x potential within the near future, within a few months? In my view, yes. In my view, yes. It's a very, very cheap stock. They have literally battered the stock. And if it did that, it would still be in the top 3 cheapest. It would be the 3rd cheapest, even if it doubled. So these stocks are so cheap. HIMS, StoneCo, and Lovesac. I'll get into Lovesac and explain what the stock is. Now, the most expensive stocks, and I'm going to get the same comments. Oh, it's always the same. It's always the same. Well, I'm sorry, but the overvaluation persists. Nvidia is still highly, highly valued in my view. Sure, it lost $100 billion in market cap in about 2 weeks. It was at almost $1,200 billion, and now it's $1,040 billion in enterprise value. So it lost a little bit of that valuation, but not nearly enough for it to not be the most expensive stock. I'm not saying it's overvalued, by the way. I make an important distinction. Note, I'm not saying these are overvalued. I'm saying they're expensive. It's very, 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 very different. This is because there's a reason why they're expensive, but still they are expensive. And Shopify is the same way. Shopify is very expensive right now, in my view, and in the way I look at stocks and valued stocks. So now let me go through each mega trend. So these are the mega trends that I invest in. These are the spots in the market, the trends in the market when I see adoption, when I see an S-curve shaping up. So my first mega trend is what I call the energy revolution stock. And eventually, I'm going to probably distinguish stocks like Enphase, STEM. I hope to add solar edge to this. And I want to distinguish my battery stocks from Tesla, because it is true that Tesla is becoming more and more an AI story. Tesla is becoming more and more a manufacturing story. And also, the automobile thesis just keeps growing faster than most of the other initiatives at Tesla, and so it's at some point you're gonna have to ask yourself, do the Tesla mega, well, not the Megapacks, but like the Powerwalls or the Tesla solar tiles, like, is it ever gonna be able to move the needle if the automobile business of Tesla is growing this fast? And the answer to that is I don't think so. That's why I think I'll put it in an EV revolution and energy revolution. I might split both of those. Anyways, Tesla got a little cheaper over the past week. It was a little more expensive 2 weeks ago. In my view, at this level, I think Tesla is still pretty cheap. I do not understand why Tesla is not trading at all-time high. I think, in general, most people who follow Tesla, we don't get why it's not trading, in the $500 range, given its potential, given the fact that the competition is not coming. We saw the strike. They doubled down on the strike today. Who knows how long that's gonna last? At this point, even if the strikes stop and they get back to work, you're going to have months of disruption in the supply chain at this point. So the competition is not coming for 6 months. They're coming with a Cybertruck. They came with the Model 3 Highland, the updated, I guess we call it Model 3 Plus. Europeans are lucky on that one. They're getting it before the US. Anyways, I just don't know what to say. This stock is still dismissed by the market, and this is the usual pattern of Tesla. If you look at the Tesla chart, if you put it on a log scale and you look at it, you see that it goes through periods of 3, 4, 5 year time frames where it does nothing, and then you have a step change in valuation, like a 5x or 10x in valuation. And once you have that step change, you're going for another 3, 4, 5 years of a whole bunch of nothing and another step change in valuation. And so that's why I think Tesla, it's more important to be in the stock than try to time the stock. I don't think you can really time that stock, but I really want to be in that stock, because I don't know which week there's going to be that step change in valuation, but I'm pretty confident that's going to happen. And Tesla, for me, it's 30% of my portfolio. It is my biggest position, my biggest conviction. I'm a firm believer in I have more stocks than most people, but I know what stocks I own, and to me, I'm heavily concentrated on the top stocks, heavily concentrated. And I realize that there's some stocks that I own that are more itchy finger stock, the whole Ben Graham view of the market, which is the main flaw of the investor is that he must do something. Well, I am one of these investors who likes to do a little something and who likes to own stocks, but I protect myself with having proper position sizing. That means I will play and own a 0.5% position in a stock like Indie, for example, which is less than $1 billion market cap and which is speculative, and I'll play with that, knowing full well that if my 0.5% of a portfolio disappear, it doesn't matter because 30% of a portfolio is Tesla. Right, 20% is Enphase. So it really doesn't matter because it's a top-heavy portfolio. That's kind of the way I design it, and that's kind of the way indices do it. Like, and in the index fund kind of does it this way. It's like you own all of the stocks, sure, but it's the performance of the top stocks that matter. So, anyways, Tesla. Expensive for my spreadsheet, somewhat, not the most expensive, but somewhat higher level expensive, a little more expensive than the average stock in my spreadsheet, but compared to the potential, there's no way I think this stock is expensive. Talking about Enphase, so let's talk about Enphase. I'm very bullish on Enphase. I am growing more and more and more bullish on Enphase. You may know that I have also bought SolarEdge recently. I've also bought SolarEdge. But my analysis of SolarEdge is really due to the fact that I think SolarEdge is slowly becoming a commercial inverter company. And if you look at how the way the business of SolarEdge is headed, they're doing big installs. They're doing commercial installs. I'm doubling down on my view that for residential solar, AC coupled systems are the way to go, which is what Enphase has. Enphase has an AC coupled system, and I shouldn't make a video about this. There's a channel that I really recommend, which is called Solar Surge, and they interviewed one of the sales leads at SolarEdge, one of the sales trainees of SolarEdge, and I just want to say that the SolarEdge is a sales machine, and they are very, 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 very good at sales. But when you dig deeper into the arguments, which I have done many times on the channel, it is not true. Like I was watching this video on SolarEdge, on Solar Surge channel, on SolarEdge, and the sales training person, she kept saying, "Oh, it's the triple penalty. Oh, it's the triple penalty. Oh, if you get a battery." And if you get microinverters, you're going to have a triple penalty with Enphase, entirely forgetting the fact that A, you're using an old model of the inverter to claim the triple penalty. They claim the triple penalty is a 10% drop in efficiency. You're using the old model of inverters. You're entirely ignoring the fact that Enphase now sells inverters that are mostly much more efficient, and actually it's 7% loss and not a 10% loss. Entirely ignoring the fact that it's the premium SolarEdge inverter that has 99% efficiency. The most installed SolarEdge inverter is a 2% efficiency. So really the delta of that triple penalty is really, really, really only 5%. That's a 5% delta. It's very misleading to say it's 10%, but that's the sales tactics of SolarEdge. It's like, oh, you have a triple penalty. But no, it's actually only 5%. And then the third point, which is also forgotten, is that it really doesn't matter, because for Enphase, if you use your energy during the day when there's the sun out, which most people do, most people use energy during the day when there is the sun out, you don't have any penalty whatsoever, because the energy goes straight from the solar panel to your house, right? The energy goes straight from the solar panel to your house, so it doesn't go through the battery. It only goes through the battery for energy that is used at night. So, and this is the same, but like they keep doubling down on the issue of clipping, which really, really annoys me, because that's misleading too. So when you analyze deeply these two companies, to me, yes, SolarEdge is a sales machine, and they're going to sell a lot of these systems. But buyers of solar are getting savvier and savvier and savvier. And when they are savvy, which when you spend 25 grand on a solar system, you're going to be a little savvy, hopefully. Just like when you buy a car, right? When you buy a car, when people go buy cars, they research everything online now. You don't need a salesman when you go buy a car. That's why dealerships are on the way out. That's why used car salesmen don't exist, because you can just do research on your own. The same is true for solar, and I do believe that when people do research on their own, they will choose the Enphase system, because the Enphase system, AC coupled system, in my view, are much, much better systems. And I'm not even talking about things like the warranty is double. The warranty is 25 years versus 12 years. I'm sorry, this is a tangent. But the more I study SolarEdge, the more I am bullish for Enphase when it comes to residential. And the less I am bullish for SolarEdge when it comes to residential, but SolarEdge as an edge when it comes to commercial. I do, and like the CEO said, they are surprised themselves by the commercial demand that they're having. They have a lot of commercial demand. Anyways, Enphase, as far as super high quality stocks go, I'm gonna put them into these tier one super high quality stock. I've called Enphase a tier one stock for me before. It is cheap. It is an inexpensive tier one company. It's a top company. It's cheap. I do not understand how it got so cheap. I see a lot of similarities with Facebook and how Facebook got cheap. You may remember 9 months ago, 12 months ago. I see a lot of similarities with that. The market entirely dismissing it, even though this has been a darling of the market for the past 10 years. Anyways, companies have inertia. You don't just stop a mega trend like this. This has inertia. Let me briefly talk about STEM. STEM is an installer of Megapack. They are installers also of Chinese energy storage system that compete against Megapack. They're in an interesting position in that they both compete and co-opete with Tesla, like on software. Of course, STEM has their own software. It's called the Athena software. STEM is cheap. STEM is the cheapest stock out there. Why is it so cheap? It's cheap because it's a small cap company. What you'll find is that most of the companies that are dirt cheap on here are small caps, and I also am beginning to think that this is an artifact of the market. In fact, if you look at small caps as a whole, they are interestingly very, very, very cheap right now. And it makes very little sense because many of these small caps have outstanding growth profiles. But for some reason, the market has destroyed the valuation of small caps right now. So STEM is a dirt cheap stock. Again, I don't understand why it's that cheap. 87% forward growth. Keep that in mind. That's tremendous. Tremendous. Let me talk about HIMS. So I am still as bullish on HIMS as ever. Like I heard in the comment section that I don't cover HIMS anymore, but there's no news. There's not really that much new news on HIMS. I'm waiting for the next conference call to talk about HIMS. But HIMS is still growing extremely fast. The reviews on these apps are still amazing. They're still getting new reviews. The app keeps performing very well. And HIMS is the cheapest stock in my coverage universe. Keep in mind they have 80% gross margin. Most of that revenue is recurring revenue, between 90 and 95% recurring revenue. They're predicted to grow 57%, keeping in mind that they're going to grow again because they gave us a long-term ARR guidance. And it's now going to be, I think it's going to be 2 years out. I mean, they had said 3 years out, but it's going to be 2 years out, in my view, from now. Or 2 years and a half if you begin in the initial guidance. They guided for 1.2 billion ARR. Well, they're at 710 million right now. At this rate, they're going to reach it in no time, in my view. This is a company that's growing very fast. Company that's coming under a lot of backlash. A lot of these stocks are seeing backlash because of what I call single issues. Like, for example, Enphase is getting sold off because of interest rate. That's like a single issue backlash. HIMS is different, even though HIMS is recession resistant. No impact on interest rates, right? So if you're a bear, you can't really say, interest rate's going to hurt him, so the economy is going to hurt him. No, because it's a low-cost leader in the medication. So now what they say for him is that, advertising is so expensive and we're spending so much money in advertising, it's not sustainable, etc., etc., etc. I've covered this multiple times on the channel. When you have 95% of real revenue that is recurring, when we know the retention is 85% retention 2 years out. That's the retention we know. So you have 85% of people that stay with the company 2 years after signing up. So that's 15% attrition. So you have 15% attrition over a 2-year period, and you have 95% recurring revenue. So when you have that scenario, and keep in mind, we have qualitative data from Omi 2 conference calls ago. Yemi, sorry, I don't know why I call it Omi. Yemi, the CFO, 2 quarters ago, he told us we have plenty of customers who are still registered, who are original ED drug subscriptions from 6 years ago, who are still registered. That's the thesis. And I've calculated with the marketing they spend and the number of new customers they get. If the customer stays 18 months, that justifies the marketing. And my bet is that customers not only are going to stay more than 18 months, but also they're going to move on to new categories and new products. Right now, on average, the average HIMSS customer has 1.5 products. The question is are they going to have 2 and 3 products on average? That's how you get exponential growth. You multiply the number of customers signing up, and then you multiply that by the cross-selling, the number of new products that they're adding on. And that's when you really get that curve, really get that exponential curve in the growth. Very bullish on HIMSS. Love HIMSS. Very great stock. Okay, let's talk about stocks that are a little more expensive right now. Wow, I have a few updates to make. So first of all, Datadog and MongoDB, they're both stocks that I like very much. I haven't touched them. I still own them fully. I haven't added either. Datadog is actually very interesting in that they're launching a lot of cybersecurity offerings now. So briefly, Datadog. What does Datadog do? Datadog is a infrastructure monitoring app. It allows you to notice problem in your IT stack. It analyzes billions of data points to look at where there could be a problem whenever you have a problem in your IT and detect those problems, and you can go fix those problems. That's why they're a little similar to cybersecurity, but on a different idea. And then you have MongoDB. What does MongoDB do? MongoDB is a document database. And Snowflake, which I do not own anymore. Snowflake is a SQL database, so it's a columnar database. So what's the main difference? Snowflake, uses files with rows and columns, right? And MongoDB uses text files, right? It's a JSONs, actually is the thing, but it's kind of like a text file, and you search in those documents, you search on those files. And there's this debate in coding as to whether SQL is better or as to whether document databases are better. And they are leading the document database or software system. They're leading that charge. Snowflake is leading that charge of SQL. The reason why I sold Snowflake is because I was disappointed. I mean, to me, the company, the CEO was outright lying in their growth expectation, which they had halved 2 months ago, and I was very, very, very upset about that, and so I sold the stock. Only future will tell whether that was a mistake or not. But I'm still happy to own MongoDB, and MongoDB I haven't sold the stock. I mean, Snowflake hasn't gone many places, anyways. So it's all okay. I mean, it's up a little bit, but I'm not too upset that I sold it. Palantir, and talk about Palantir. Palantir, I have to be honest, is a stock that I started selling a little bit. Yesterday I sold a little bit, and 2 days ago I sold a little bit. Because Palantir right now, in my view, is getting a little expensive, a little overheated. The growth is slow. Let's remember, the growth is a little slow for Palantir. And I know you're showing an 80 million contract here, a 250 million contract there, but these contracts are over multi-year contracts. They're not going to move the needle that much. My threshold was 30%. This was a stock that was supposed to grow at 30% for the next 10 years. That's what the CEO had promised us. And this is not what we're getting. I don't want to completely sell out of Palantir because I see the vision, but I'm trimming a little bit right now because it's still a top 10 position. And if you look at my top 10 videos, it might not be a top 10 position again for me pretty soon if that valuation keeps going up. The growth is a little low, and maybe Q3 will change that, but the valuation has to somewhat reflect the growth. So anyways, I'm done with Palantir. Let me tell you about CrowdStrike, Zscaler, and Cloudflare. CrowdStrike is a company of network effects. They have a network of cybersecurity endpoint systems, right, which they call the Falcon software. You install that on your laptop, on your iPhone, on your devices, whatever they are. And whenever there's a breach, CrowdStrike, the cloud-based system of CrowdStrike, detects that breach and broadcasts a fix to that breach to all computers in the network. And this is why many companies just want to have the best. You need to have the best. It's a winner-take-all market where the largest your surface of attack, the more you collect data on attackers, and the more you can share that data with everybody else. It's kind of the same reason why everybody buys on Amazon or everybody tries to learn English, because everybody uses English, right? That's the whole reason. Well, people are flocking to CrowdStrike for the very reason that everybody uses CrowdStrike. And this is a company that gave us 10-year guidance now. And so, no, sorry, not 10 years, 5 to 7 years, but they've updated guidance until 2030 is what I meant. And so that removes a lot of risk when you update your guidance. I made a specific video on CrowdStrike. What about Zscaler? I love Zscaler very much. Zscaler prevents the spread of an attack on one compromised device to the rest of the network. So let's say CrowdStrike didn't work and you have a laptop that gets infected. Zscaler prevents that laptop from connecting to other systems in a company. That's what Zero Trust does. You don't have two devices that connect to each other with trust. There's never any trust with the devices, and thus the virus can't move from one device to another device. Zscaler is the leader in its niche, and I'm very optimistic about this company as well. I haven't changed my position in Zscaler. I've increased my position a little bit in CrowdStrike lately. How about Cloudflare Net? Cloudflare is the more expensive stock out of the free crowd cybersecurity stock. Cloudflare, I mean, is a great marketing machine. They have a lot of dedicated shareholders. A lot of people love the shareholders. They've promised a lot. They still have to deliver on a lot of their promises. What is a Cloudflare? Cloudflare protects websites. So they hide the origin of servers of websites so that websites can't get attacked by hackers, etc. So that's what Cloudflare does. It's a VPN for websites in layman terms. How I would describe it. Keep in mind, I'm not an IT professional, so my descriptions are very approximate. But it is what I understand it is. It's a VPN for websites. It hides your IP address, the IP address of websites, to potential attackers, and so they can't attack. That's for cybersecurity for you. Okay, let me move on to e-commerce. So in e-commerce, I have MercadoLibre, CLimited, and Shopify. I'm out of Shopify, as I've said before. I think Shopify is very expensive. Yes, they're the leader. Yes, the partnership with Amazon Web Services. No, Amazon Delivery Network. That partnership is impressive. Yes, they're the go-to company that powers a lot of very large businesses, including other online businesses. For example, Figs right there is powered by Shopify. The Tesla merchandise store is powered by Shopify. So they power a lot of big businesses. But that valuation, I just can't justify. I think some of it has to do with the fact that it's a Canadian stocks. For some reason, Canadian stocks are very expensive. But I just cannot justify that valuation for that level of growth. 21% is too slow in my view. Now, what about CLimited? I am turning bullish again on CLimited just because the game in India, Free Fire, has been allowed again. It's been allowed again, so we'll have to see how we're doing in India now that they are relaunching their Free Fire game in India. Remember, my main complaint, I'm consistent with myself, my main complaint about CLimited has never been the e-commerce division. It's never been C-Money. It's always been the gaming division hurting the growth, because their gaming division had almost been halved in 18 months, 16 months. It was halved, the gaming division. That was killing the growth. Now, if the gaming division is coming back, their most popular game, Free Fire India, if it's coming back and if people sign back up, we should not see that depletion in the gaming division anymore. And if we don't see that depletion in the gaming division anymore, this is a company that can grow again, and I am optimistic again about this company, but it will be dependent on Q3. We'll have to see how well the gaming division is doing. This is key in Q3. MercadoLibre, MercadoLibre is really as perfect as a stock gets. I have a hard time finding issues with MercadoLibre. They're the leader in Latin America. They're selling more and more. They have an and a fintech division that is doing very, very well. That is actually entering the physical market. Great net promoter score, great marketing. They are navigating difficult environments like Argentina and doing well in Argentina. And very inexpensive. And they're doing better than Amazon. And C Limited is not doing very well in Brazil, even though it was supposed to. And Amazon is only like 10% of the market in Brazil. And their competitor in Brazil went bankrupt. There's so many good stuff going for MercadoLibre. This stock is very cheap. I don't really get it. I don't really get why this stock is so cheap. I mean, we have, almost, a little more actually than 2 decades of execution of MercadoLibre. They keep executing very well. Very happy to own this stock. It's a top 10 stock for me. Let me move on to now payment stock. DLocal, StoneCo, and Square. So DLocal and Square, they're positions that I am slowly phasing out. I've been unhappy with a few things about these positions. Although DLocal will have to see because they're getting a new CEO. I'm waiting to see in DLocal. DLocal has been under relentless attacks from short sellers, and they're also in a competitive sector. The online payment system is a very competitive sector. And you have competitors like Adyen, for example, is a big one. And we'll have to see where this goes. DLocal partners with a lot of Western companies, and they enable payments in more than 30 emerging markets and emerging nations. They enable payments online, and so they allow you, for example, to use your country's very specific payment system to buy, a Microsoft Office suite, for example. That's the crux of the business of DLocal. But there's no denying that they've been hurt by these short sellers. Now it seems like these times are gone, and that's why I'm looking forward to seeing what's going on. It seems like these times are gone. Now Square, Square is and by the way, DLocal, all 3 of these stocks are inexpensive. Square is a story of low growth at this point, in my view. The growth has stalled. The Cash App is still the absolute leader, but I do not know why the Cash App is not, growing faster in some sort of way. That growth has stalled. They are the leading, digital app for cash payments, digital cash payments, and they are the leading swiping, payment for small business, where you can swipe your card at small businesses. So payment terminal leader. So they are the leader in this space, and it seems like now they are growing at the pace of the economy. And so to me, it's if you're growing at the pace of the economy or barely higher, you need to find a new area for growth. And I have not seen this new area for growth for Square. They need to start monetizing Cash App and becoming a bank for Gen Z with Cash App. But that also is not happening, or not picking up maybe as much as they had hoped. So we will see with Square, we will see what it does. Now, my favorite stock in the payments company is StoneCo. I love StoneCo, Stonier. It's the second cheapest stock in my universe. And when you look at those numbers, it is stunning. The gross margin is 73%. The revenue growth predicted 40%. StoneCo has about 3 million payment terminals in Brazil, 3 million and growing. Sure, there is fierce competition. There's competition from PagSeguro. There's a little bit of new competition from MercadoLibre. But, once a small business has a payment terminal, they're going to stick to it. They are still going to stick to it. And this is a company that's growing at 40% predicted growth over the next 12 months right now. That growth, if that makes some sense, does not stop like that, right? That growth does not stop quickly, does not stall quickly. There's usually a curve, an inertia curve. And when inertia is there, it takes many, many years for the growth to become flat, to become more an asymptote, if that makes some sense. So it's very, very rare, except of course in 2020 we saw it for a few businesses, but for most businesses it's very, very rare that you see growth just stop. Just stop, right? The more common scenario is you have 40% growth this year, and then 35% next year, and then 30% the year after, and then 25%, and then 20%, and 5 years went by, and actually that business really, really, really grew. So I'm still extremely bullish. I don't understand why this stock is this cheap. Yes, it's a small cap. Yes, it's in Brazil, but there's benefits to being in Brazil, like the drop in interest rates, like the fact that adoption is still going on strong, right? It's still a cash economy, so a lot of small businesses are adopting these payment terminals. I don't understand why it is so cheap. Moving on to my chip stocks. So this is gonna be very, very quick. AMD, if you are going to buy one of the majors, in my view, AMD is much cheaper than Nvidia. But there's very real statement to be made that Nvidia may not be that expensive at this price if they're actually able to grow at, say, 50, 60% next year, right? This is what analysts say, 28%, but they haven't really updated that. They will update that, right? They keep surprising to the upside. How many of these chips are going to grow? We are in the entirely unknown. We really don't know. It's just not a risk that I'm willing to take because I am not an insider of this sector. So I'm not willing to take that risk. And AMD, I think, is a much more diversified stocks. They have an embedded electronics division. They have GPUs. They have CPUs. They're much more diversified in my view, but they also grow slower. So we'll see. And keep in mind, there is some correlation in these stocks too, at least in AMD and Nvidia. You have a little bit of a correlation. The last stock in there is INDI. INDI is an enabler of ADAS system, of any type of semiconductor, like Apple Car Key, for example, is one thing that they do. And they sell these semiconductors exclusively to the auto sector, to the automobile sector, the one that is competing against Tesla. And their growth is stunning at 103%. The gross margin is 47%. I am quite impressed by these numbers. I've listened to a few conference calls from them and a few interviews, and the CEOs are the CEO, and they have a partner too. The CEO has a partner in there. The CEO is an industry veteran. He's been doing this for a long time. So we'll see. We'll see how this goes. But this is a company that is very, very dirt cheap and that is thriving on providing semiconductors to the competition of Tesla. And so we'll see how well this goes. Let me move on to my lifestyle stocks. So I have 3 lifestyle stocks: Celcius, Figs, and Love. So Celcius is a very, very, very popular beverage in the USA. Very rarely do you go today to a grocery store and there's not an aisle with Celcius, either the little Celcius packets or the Celcius beverage. The thesis of Celcius really is, could it be the next monster beverage? The partnership of Celcius with Pepsi seems to be doing very well, and they are getting distribution everywhere. This company is growing at 76% with 45% gross margin. The beverage business is a business which historically has been unattractive to investors because people believe that you need distribution to be able to sell the product. If you don't have distribution, you can't sell the product. Now, of course, that is slowly changing. A lot of people buy their Celcius on Amazon. They buy these packets on Amazon. They buy these packets online. That's kind of changing upside down, and also the way marketing works these days undermines kind of the value of distribution, because you can get customers who walk in stores who want products that they've seen online, and so then the distributor has kind of no choice but to carry the product because customers require those products. That's how you explain a whole lot of new beverages coming up, like Liquid Death, for example, is one. Another one is what Prime. Another one is these new beverage brands that come out of nowhere. They come out of nowhere because of their marketing machines online that push the consumer, typically the young consumer, to request these at grocery stores, at convenience stores. So anyways, the thesis of Celcius is could it be the next energy beverage? Could it be the next Monster? There's a lot of things to love about Celcius. One of them is the product as a more youthful, more healthful marketing. It's really marketing itself to kind of this healthy lifestyle. You really don't get that vibe from, say, a Monster, right? A Monster beverage, it's kind of a yellowish beverage. You don't get that health sentiment when you drink a Monster. So that is one of the things we are monitoring. Same for Red Bull. Red Bull suffered a little bit from this extreme view, but not this health view or fitness view, which I think Celcius has. So it seems like a lot of people are adopting Celcius. Another thing that I love about Celcius is possible European expansion. When I was in France last summer, I was looking at grocery stores to see energy beverages. Monster is very, very big over there, and I assume it's the same in Europe. There's no Celcius to be seen. So if this follows, Celcius will be seen at some point, right? If this follows this setup. So this is a company that's really going to grow. To me, the biggest threat of Celcius is that it gets acquired by Pepsi. That's to me the main threat. Celcius getting acquired by Pepsi. That's it. Lovesac. What is Lovesac? Lovesac is they're known for bean bags and what they call sectionals, which are reusable furniture. They're essentially a random furniture company that's targeted at millennials and at Gen Z. The reason why I have Lovesac in there is because it's a crazy valuation for that level of growth. 22% growth, 53% gross margin. The valuation is dirt cheap as StoneCo, as cheap as HIMS. The only way I can explain this valuation is the market thinks, well, nobody's going to buy furniture ever again because the real estate market is down. That's all I think. Figs. Figs is a stock that I am disappointed in. That growth has stalled. I covered the stock a few months back on the channel. I'm disappointed by that stock. I'm going to exit that position. If it doesn't work, you should exit. Initially, my idea of Figs is that the scrubs could do what yoga pants did and what Lululemon did, but what I found out is actually the growth is just disappointing for Figs. So we'll see how big they get, but it's disappointing. These are the lifestyle stocks. Let's move on quickly to the niche, to the cloud niche stock. I have DigitalOcean and Axon. Not much to say about these two. DigitalOcean is a cloud system that focuses on small business, that focuses on developers, and it allows you to access the cloud for a fraction of the cost of, say, an Amazon Web Services. And actually, most customers of DigitalOcean only pay something like $50 a month. So it's very popular among small business, very popular among developers for them to use the cloud. Let me move to Axon. Axon has done a lot of businesses in the past. Right now, the big business for Axon is the body cameras for police officers. The future business, in my view, for Axon is storing these videos from police departments into the cloud, and they are selling cloud service and cloud software to those police departments that have those video cameras, and that's why I classify Axon today as a cloud business and not a cloud niche business. And of course, it's very attractive because then you can grow much faster if you're operating in the worlds of ones and zeros as opposed to operating in the worlds of brick and mortar of atoms, right? So operating in ones and zeros typically means higher growth. I am curious to see how higher the growth is going to be. Both of these stocks are a little bit on the cheaper side, but not dirt cheap, obviously here. Let me move on to Nubank and SoFi. So Nubank is a little more expensive than SoFi. I've been adding a little more to SoFi right now, although I'm still undecided. I am undecided as to which stock out of the two I prefer. I'm really undecided. This morning, for example, I'm feeling a little uneasy about SoFi again because I see the headlines everywhere about a new student loan widespread forgiveness and a new plan being put forward. That's what I saw this morning. It made the headline. So there's going to be new ways for the debt to be canceled, and as long as this is a stock that's associated with student loans, I could see this stock not trading based on its fundamentals, which its fundamentals are: the digital bank is doing well, the product is getting adopted, Customers are joining SoFi not for student loans anymore. They're doing much more than student loans. The thesis is the end of the branch, the end of the consumer retail branch. That's the thesis for investing in SoFi. But the market keeps associating this stock with student loans. And, this morning it made the headlines again. Is there going to be another student loan forgiveness plan? Is there going to be something with a different name and we're not going to call it student loan forgiveness? But then results will be the same, which is less refinancing. And if it's less refinancing, the market still thinks it's a student loan company. I mean, look at what happened to a stock like, for example, StoneCo. It's been 2 years that STNE moved on from its collateral issue. But the market is still granting it a next to nothing valuation because it forgot that STNE moved on, right? And so how long is it going to take for the market to realize that SoFi is not just a student loan business? Just like how long is it going to take for the market to realize that Tesla, well, it's very slowly realizing, but it took years for the market to realize that Tesla is not an auto company. Right? Slowly, but if you're a long-term investor, it's not a problem. If you're a short-term investor, it is kind of a problem. Nubank does not have these issues. Nubank is growing very, very fast, and so today, right now, I'm still liking Nubank better. Obviously, the problem with Nubank, no, it's not really a problem actually, but the consumer of Nubank, the average consumer of Nubank, is not going to have as strong as a potential as, say, high earners at SoFi, because SoFi is really targeting the high earners, the highest income millennials, and so you have an opportunity for cross-selling, which I believe in absolute value is much, much, much higher for SoFi, for example, than, say, for Nubank. But Nubank will get there. So I'm very positive on both stocks. I don't know which one to choose, quite frankly. I own both, and they're roughly in equal positions. I own a little more SoFi right now, but these are stocks that I modify my positions around, pretty often. The last stock is the platform stock. It is Airbnb. I love platforms. Why do I love platforms? Because companies don't have to produce anything, and they typically don't have to do any marketing. The network does the marketing for them. I.e., people who look for accommodation today, they just have the Airbnb reflex, if that makes any sense. They're like, oh, I gotta stay in this town. They just look on Airbnb. They don't even think about looking anywhere else. That's what a lot of Gen Z do. That's what a lot of millennials do. The competition is really Airbnb. They say they've addressed about 10% of the hotel disruption that they could potentially address if they replaced hotels. Let's imagine they disrupt another 10% or another 20% of hotels. That's a 3x from here. Airbnb is a best cost product. It's a better product, and it's a less expensive product for when families travel, for when a lot of Gen Z travel. A lot of people really prefer the authenticity of Airbnb. And you're doing this without having to expand any capital. At least Airbnb does not expand the capital. The capital outlay is done by people who list on Airbnb. So that's why it's a very desirable business in my view. Platforms are the best business in my view. That's why I've covered more and more platforms on this channel. You may remember me covering Rover, which is another platform that I'm interested in. I still need to cover Xometry pretty soon on the channel, which is another platform. DoorDash as well. I love these platforms because you don't produce the good. You're just a layer on top of the transaction. You're just a layer of trust, and you take a really nice take rate, and you don't produce the good. You just facilitate the transaction. And lastly, I'll finish on this. The Airbnb, to me, the long-term value proposition of Airbnb is: are they going to replace mom and pop renters? About 20% of stays on Airbnb are longer than 28 days. They're long-term stays. You have Gen Z who live on Airbnb. Is this going to be the future? I don't know, but I think it's part of a long-term thesis of this stock. I'll conclude by saying that Airbnb is also a very, very profitable stock. So just like I have two stocks in it that fit this, Airbnb and StoneCo. StoneCo and Airbnb are two stocks that not only grow very fast, but that are also owned by value investors. So isn't that interesting? Because they have great profit margins that appeal to value investors. So both Airbnb and StoneCo appeal to both growth investors and value investors. And I just think it's interesting. It was worth mentioning. So anyways, this was likely a very long video. I don't know how long the video was, but I hope you appreciated it. This was not investment advice, ever. Not investment advice, just entertainment. I appreciate your likes. I appreciate your subscribes. Thank you for watching and have a wonderful day.